calendar year, all eyes are on the hospitality space. IHCL has been in focus, opening a property in Tawang today. So the northeast frontier is also there on the map of luxury properties. Now IHCL owns some of the leading brands in the country such as Taj, Ginger and Vivanta with 250 hotels in 12 countries. The number of hotel openings this fisc is 14, which is on track for their guidance of 20 for FY24. And we should quickly pull up what that one-year chart has looked at as well for Indian hotels as the supply-demand mismatch continues in the space. But to speak more on their outlook for the business and sector, I'm joined now by Puneet Chhatwal, MD and CEO, IHCL. Mr. Chhatwal, a very good morning and thank you so much. Great to have you on NDTV Profit. Tamanna here. So I'm going to start by asking you, if I were to want to book any kind of property right now for the New Year's weekend coming in at any of your properties, would there be space available or are you jam-packed?
Wow, it depends, you can always give me a call if you're not making progress, but yes, there are spaces available. It's always a question of price, destination and connectivity. So I think, but the sector is doing very well and the occupancy levels are very high and that allows us to have a higher ability to charge.
So the question was to get a sense of what this period is looking like for IHCL and for the industry. How much higher are the rates and what are the kind of occupancy levels we're seeing over these 2 weekends and this entire Christmas New Year's period?
See, there is an increase year to date over the previous year in a double digit, depending on which brand and which locations. All markets are almost in higher double-digit growth, 12, 14, 17, 18%. And very important, most of this growth is coming through higher average rates, which would obviously increase profitability. So that is generally for the sector. For us, we have already declared the first half results, which were, indicative of 30% more profitability versus the first half of last year. And given what we have seen in October, November have gone very well, and December year to date is looking also very good. And each day between today till the 1st of Jan is high revenue. And the question is, how high will it be based on the business on books as well as the pickup? We remain fairly optimistic that we will finish the year on a higher note and also with very good rates, good occupancies, good wedding season, all in all, very, very positive.
So Q3 traditionally, Mr. Chhatwal, is a great quarter for the company, and you saw Q2 looking robust but a little tepid compared to Q1. Can you give us a sort of an overview of how you're looking at the second half workout and what are the standout sort of numbers you're seeing in Q3?
Well, Q2 is the weakest quarter traditionally, but we still had a big increase in all, revenue, EBITDA, in margin and in profit after tax. Q3, as you rightly said, is the strongest quarter, especially for us because we are a very well-hedged portfolio. We have a right balance of resorts, especially with the Taj brand, which is the backbone of the company, and also business hotels. So I think till the 15th of December, business hotels do very well. And in between, the festive season of Diwali and other holidays, and then the Christmas and New Year, the leisure hotels tend to do very well. So our palaces in Jaipur, Udaipur, Falaknuma in Hyderabad, or our resorts in Goa and Kerala, this is their time. This is when they charge the highest. This is where it is very difficult to get places, including in our homestays. From what I heard this morning from my colleagues, all our homestays under the brand name Ama are sold out in Goa. And we're trying to finish 4 bungalows actually today so that we can open them tomorrow and accommodate more demand.
That's crazy. We've been hearing about these stories, highways jammed, people flying into Goa and other tourist destinations. So definitely the appetite is there. The question is about sustenance and what it turns into in terms of figure. So if I were to ask you, Mr. Chhatwal, for your outlook in H2 for your ARRs, revenues per customer, EBITDA margins, are you on track? What are the kind of numbers that you're foreseeing?
Currently, Tamanna, we are ahead of our guidance. I see no change than what guidance we have given for like the short term till 2025 under our strategy Avant 2025. That is of 33% EBITDA margin, approximately 300 plus hotels, which we actually increased to 325 by the time we finish 25-26. So we are very much in track, but more important is to understand what you said, sustainability of this kind of development in revenues, occupancies, and margins. There is a shift in this sector. This is not anymore, like a luxury or a sector just driven by, volatility and cyclicality. There is cyclicality. However, travel has become a need, a fundamental need, because you're traveling to tier 2, tier 3 cities. Everywhere there is infrastructure development, people need to sleep somewhere, right? So 90% of the supply in India is non-luxury supply, and that is also fueling demand going forward. The number 5 economy in the world with aspiration to become number 3 will bring certain structural changes and a certain shift. And I am very, very confident that this sector starts moving more and more towards a consumer sector than just a leisure, discretionary, and a luxury sector. So, and we see that. We just opened our flagship property in Santa Cruz, the Ginger. It's not even 1 month in operation, and the way it is performing is extremely different than what we are used to 120 years of Taj. So this change is happening as we speak, and this is very good news for the hospitality sector. The supply will remain constrained, demand will show 8 to 10% increase per annum, and that would mean that your ability to charge would be higher and your ability to drive profitability and good margins is higher.
Strategically, are you focusing more on the non-luxury space going forward?
No, it would be not prudent to ignore our flagship, our crown jewel, not just for us, but for the country, that's the Taj. Yeah. However, we have divided recently our traditional businesses, that's Taj, Vivanta, and our platform of selections, and new businesses under a new head for which we call the reimagined Ginger, Ama, and Cumin. And we want to scale up these businesses very fast so they start becoming 20 to 25% of the total revenue of the company. This also includes certain initiatives like our private membership club, chambers, which we are scaling up. It includes certain standalone restaurants, as well as, I would say, a lot of focus on the reimagined TajSATS flight kitchen business, which is currently having more than 50% share of all the meals served in the air. So I think from a diversification of top line, from a diversification of brands, and from the sources of income, we are a very well hedged portfolio, whether we talk of brands or we talk about leisure, business hotels, national, international. Somebody is always doing well, and some places are not doing so well, and so it all balances out, but especially the Taj continues to outperform its entire comp set.
Puneet, good morning, Niraj here, must say compliments. I just came back from a Taj stay in Jodhpur. It was fantastic. I visited your Taj 3s at Vikhroli. Very, very cool. I wanted to ask you 2 questions specifically. One, you mentioned Taj stats, and I remember in a conversation that we had earlier, the conversation was that room rates now don't account, they still account for a majority, but they are no longer such a vast dominant in your overall scheme of things when we were talking about 2023. I understand from a 45-55 ratio that I presume was there, how do you anticipate 2024 and 25 to be when it comes to the split between the different business lines of IHCL?
We are very blessed to have very strong food and beverage business in the Indian subcontinent. So if you look at the recent news on how many, I think 38 lakh weddings or 40 lakh weddings happening, and if you take the fair share of that demand into hotels, it's a very big business. With the improvement of the infrastructure like Bharat Mandapam in Pragati Maidan or, Dwarka, the Yashobhumi or the Geo in Mumbai, when they are having events now, everything in and around is sold out. Now, these facilities never existed before. The same time, you can see all the airports getting extended, connectivity because of this Udan scheme getting easier and easier. This is going to fuel both rooms revenue as well as non-rooms revenue growth. But because we are very strongly driven by the Taj brand today, and Taj hotels have a lot of non-rooms revenue, this proportion will stay somewhere between 45 to 50%, but definitely not more than 50%. A lot of non-rooms revenue is very important source of the diversification of our top line that I spoke about.
Got it. And the other question, Puneet, I presume your hotel openings are on track, but I remember at the start of 2023 or midway through 2023, the conversation was that with the G20, with the World Cup and a few other things, the traction for the space is very large. Now, I know in recent conferences, you and some of your peers have said that it was not, relative to the kind of growth seen, it was not so disproportionate that it will impact 2024. So therefore, my question really is, as you look forward to 2024, what are the key drivers which will drive growth for the hospitality industry and for IHCL in particular?
Well, in general, Niraj, it will be fair to say that the supply cannot just come, out of nowhere. It takes time to get approvals to build hotels. And also, build the infrastructure around it. So the supply will remain constrained, and based on some studies by some hotel consulting companies, the majority of the pipeline of supply is not in your key metros. It's as per Horwath, more than 50% of the pipeline of all companies put together is in non-metro locations. Now, your metros are key drivers of revenue and profitability, like Delhi, Mumbai, places like Rajasthan, Bangalore, Kolkata, Chennai, these are markets which are not seeing that kind of significant addition in supply. So the demand keeps outpacing supply. That's number one positive. Number two is G20 was a one-off event, but there are so many other events that are happening. There's so many other championships, from a Kho to a IPL for, the seniors, and all kinds of sports events which were not happening like that before. There are different conferences coming in because we did not have the possibility to host 3,000-4,000 people under single roof. Now that's also happening. The weddings are on all-time high and will stay like that. And I remain fairly optimistic that G20 was there, and actually I personally believe that G20 did a great for marketing India as a destination globally. It's not some kind of a tactical sale so that you immediately start seeing an impact in terms of foreign tourist arrivals. But over longer term, at least in the G20 participating nations, the destination India has got far more established than it was before. So I think we tend to forget that some of these things have a long-term impact on the business and on the sector, etc.
Mr. Chhatwal, you've spoken about the demand-supply mismatch, and this is something that we're hearing from other industry players as well. I want to understand your plan and strategy to close that gap. How are you going to do that? Is the management segment also going to be a focus?
See, majority of our pipeline, which is today 85 hotels, so we are opening 2 hotels a month. We are signing almost 2.5 a month. And these contracts are management contract driven businesses. Our guidance has been in 3 years to triple the amount of management fee income that we had, from 200 crores going on to 600. And that's something which we are very pleased about, and that is bringing the balance in the portfolio that we were looking for. 50% asset heavy, 50% asset light, going in a fast growth mode with all the brands, especially our new businesses. So all in all, I think this journey will continue of, even if we stop signing any new contract today, we'll be opening 2 hotels a month for the next 3 years.
Oh, that's quite a speed. Just one last point, Mr. Chhatwal, your outlook for 2024, is it going to be driven as it has by domestic tourism? Are you expecting, inbound tourists to come back? And what is the kind of hike we're expecting in room rates?
Let me answer this in 2 forms. One is in terms of foreign tourist arrivals. We are still not at even 60% or 70% of where it used to be. So it's a big opportunity, and domestic is definitely driving, as India is seeing good GDP growth, good increase in per capita income. So I think that is going to definitely drive demand. And this, I would say, the new lust of the consumers to travel on longer weekends, which really started during COVID. So there is a shift in the customer behavior of people getting into their cars and driving off for a long weekend, whether they go to Uttarakhand from Delhi, or they go to Goa from the west, or they go to Coorg or Chikmagalur in the south, or in the northeast. So I think that is a permanent shift. This is not going to change. The second important factor is that because of the supply constraint, demand should keep increasing. And it is not just next year. I can say with a great degree of confidence that hospitality sector is at the beginning of an upswing for next 3, 4, 5 years for sure, because this kind of demand we have not seen before. We saw it between 2003 to 6 or 7 on the domestic front, but that was because there was very limited supply. Now the supply is there, but its only demand is growing faster. The second important, when it comes to Indian hotels, for us, very big opportunity is our international assets. 3 of them, or let's say 2 of them in the US, are currently low performers because of what's happening in the US market. One of the assets is in San Francisco, and we all must have read or seen short videos on social media. So that's a big opportunity for us, because when they start coming back, they will further add to our robust top line, which is already diversified in a very strong fashion. So all in all, I remain fairly optimistic about the next year and beyond.
That's definitely an optimistic outlook, and that's why, Mr. Chhatwal, you're saying that you're on track to go beyond your guidance. Is that going to come from cutting costs, or more demand fueling it? Our strategy has been to be most iconic and most profitable company from South Asia. That's the guidance we've given. Yeah.
You can never be most iconic if you are only driven by cost orientation. So we spend where money is needed. Our asset management initiatives are driving our operating leverage. I would welcome everyone to go and see the relaunched Mansingh, the Taj Mahal Hotel Delhi, popularly known as Taj Mansingh, which we did on 30th of November. We have added some great facilities in Taj Lands End. We have added a new Chambers in West End, a new restaurant. So all this is adding cost, but it is driving more and more revenue, because all these initiatives are margin enhancing and also brand enhancing. So we get both the benefit of staying most iconic and also driving revenue, especially in places which were underutilized. When you're such a legacy company with such legacy assets, there is enough space that can be reimagined to create new sources of revenue and income. And that opportunity we have had in the last few years and have been able to demonstrate that.
Absolutely. We look forward to seeing the journey because, like you said, Taj has finished 150 years. So it is a great. It is a great.
120, just a correction.
120 years. So it's a great company, but it's also an Indian icon. So thank you so much, Mr. Chhatwal, for speaking with us today on NDTV Profit.
Thank you.
All right, so that was the IHCL story, but all eyes on 3 new listings. And pre-open rates are already telling us there's going to be a bit of a pop. Look at those pictures coming up on the in-studio video wall, where we're going to see what happens with Muthoot Microfinance, Suraj Developers, and Moti Sons Jewelers. You know, Niraj, what really strikes me is the kind of appetite for any and everything.
6 SME IPOs this week as well, even though main boards are taking a bit of a step back, but it'll be interesting to see what happens post-listing, post the next 10 days, Tamanna.
Yeah, so listing in just a few minutes from now, and pre-open rates are already telling us that there's going to be a bumper at least on 2 of them. I'm not sure about Suraj. I think Suraj pre-open rates is at a bit of discount, but Moti Sons and Muthoot. Remember, we've talked, or you're going to hear from us on NDTV Profit, a conversation with all the management over here. So you should tune in and see what their plans actually are. We're going to take a very short break, but we're coming right back. Stay tuned to NDTV Profit.
Thanks for tuning into Talking Point. I'm your host, Niraj. Our guest today is Dinshaw Irani, CEO of Helios AMC, with us in our studios. Dinshaw, so good having you. Seeing you in person for the first time, good having you.
Thank you, Niraj. Thank you for having me on your show.
And the pleasure is entirely ours. So, momentum, when I remember when we just launched, or maybe even before that, we had a conversation with you, and you had mentioned about how the momentum is strong in your belief, Will, that the markets don't have a reason to correct. Now, we've traveled a fair degree from there. Is your conviction still the same?
I think so, Neeraj. In fact, my conviction has been further enhanced. Obviously, a big, I think, probably the one which could have had a problem with the markets was the election results and the state election results. They came out pretty much in favor of what the market was expecting. In fact, more stronger than what the market was expecting. So that was one positive. The second one was the way the US yields corrected, I would say, in the sense that the 10-year paper was at 5, came off to around 3.8 or something now. So it's been fairly good for the markets. I think that was another hiccup that was there. In fact, as I told everybody that if you had come to me in September, October, I would have told you to stagger your investment because that's when the spreads were pretty huge out there. But now that the things have become improved further, we are in fact suggesting that put in lump sum. That's what our feel is.
You're asking people to put in lump sum now?
Yes.
Wow.
And that's where the conviction comes in, I suppose.
I agree. No, but typically that would happen when you have conviction not just about the long term, but also about the near term not looking too difficult.
Right.
That comes from the fact that all the factors that you mentioned will take care of the valuations?
Yeah. So as I said that in October, the spreads between the 2-year and 10-year paper was down to around 10 basis points. And that's mainly because the 10-year paper got sold off. And as a result, the yields moved from some 3.6, 3.7 to almost 5%, right? And that's actually, there's a term for it. It's called bear steepening of the curve. So that was what was worrying us because we thought that maybe the market is taking a view that the pain in US is going to last longer. And as a result, the yields have moved up for the 10-year paper. And obviously, the world has to live with the high inflation, right? But that got corrected in the last 2 months as such. And that's where the real comfort came from. That now it seems as if, and by the way, the dovish statements from the Fed also, I think, reiterated our view on the market that they're also looking at cutting rates probably going forward, probably in the second half of the next calendar year, which is CY24 I'm talking about. So it's obvious, and by the way, my belief is it won't be 3, it'll be more than 3. And I think it'll be smaller cuts because the Fed has to indicate to the world that things are getting back to normal. So maybe that is how it is. So that's why we are more bullish. And as I said, one big hurdle could have been the central elections, but that seems to be out of the way, and that's why we believe that even in the short term. By the way, one caveat out here. I think the large caps are definitely going to outperform the mid and small. That's what our belief is, and that's why our portfolio is leaning more towards the large caps.
Well, one of the things that is very evident at the small cap or the broader end of the spectrum is what's happening to the IPO market, right? And we're just about a minute away from those listings, so we'll mark them as well. But does this excitement worry you in the IPO markets?
It does. Actually, it does, Niraj, because I think some of the IPOs are fairly frothy. So I won't name them, obviously. But we believe that the kind of valuations that they're commanding, in fact, you look at the grey market premiums and then you look at the way the listing happens, it's obviously two different stories altogether. Yeah. So it's more of I think, a very well controlled market, I suppose. So that's what worries me more than anything else. And I think the retail investor may just go away having a bad taste in his mouth, which is not good for the markets.
Yeah, well, 3 listings, and let's just mark them just about 10 seconds away from these stocks getting marked, and then we'll of course get in what each of these are listing like. The pre-open discovery price seems to suggest that Moti Sons would have a Moti listing, if you can call it that, but stunning listing for Moti Sons anticipated, yes, 88%, so 105. Not so much for Suraj or for Muthoot Microfin, and that, the Muthoot thing is a bit of a surprise because I got subscribed. I think the pre-open discovery was also not so bad. Maybe I'm wrong, but clearly, if you thought that everything gets subscribed or oversubscribed will have a positive listing, I think today is probably the first sign that may not be the case. Interesting. We'll, of course, go through each of these, but viewers, remember that my colleague Sajid and marked in today's editor's cut about there being some points to ponder around Moti Sons as well. So that's part one. We'll be doing a conversation. Our entire editorial team will be doing a conversation with each of these three managements. So should you want to know if you are subscribed to them already, or what to do here, what are the managements saying, I think you might want to tune in onto different shows at NDTV Profit during the course of the day to try and figure out what is it that the management commentary is as well. But suffice to say, Moti Sons, good listing, the other two, not so. Now, let's extend that point, Dinshaw, IPOs. And you mentioned that in some sense, the SME space, you can understand 7 IPOs last week, 6 IPOs this week. The term managed can be used in certain cases as well. But the kind of frenzy in the main board IPOs, Azad Engineering, 80 times subscription at the implied market cap, an engineering company will trade at whatever 50, 60 times FY25. These are unheard of valuations for listings.
Agreed, Niraj. That's what actually that also shows the dearth of ideas, right? I mean, there's so much of money chasing these SMEs today because the flows are mainly into SMEs, right? I mean, rather mid and small cap funds. And I think they are by force driven to these kind of IPOs, which they want to hope that things work out perfect. But as you rightly mentioned, those valuations, they're really stretched. I mean, any small disappointment and the stock can correct quite a bit. So that's why you saw that in 2 of the listings. It wasn't that fancier listing. In fact, the third one, I don't know why that price is where it is. We are not comfortable with either of these. So
yeah, and this scrape has played in the past. I mean, viewers don't need to look too far back. We've seen the tech internet-based IPOs, which are probably much more stable companies, right, coming off 70-75%, right, from the peak. So it's not that it's been played it too far back.
True, I agree. And that's what worries us, because this is what you may have some new investors coming in there, and that is where there may be some, as I said, bad taste in the mouth. In fact, if you start off something and it comes off on a very bad note, you may just stay away from the markets for a while. So that is what concerns us more than anything else.
Yeah, and viewers, remember, I mean, Dinshaw is here, and therefore I make this point. By the way, let's keep those prices going of the 3 listings, and then we'll talk about the broader markets too. But remember, Helios may have liked some of the companies that got listed in the last 2-3 years, but they didn't make a beeline for a Paytm when it was at whatever 1,800, 2,000. They bought it when the price corrected. I'm no one to suggest that Muthoot, Suraj or Moti Sons will correct. Very likely that some of these will see some gravity, and Muthoot and Suraj are already showing that. But the point is, please look at the valuations of some of the companies that you're applying to. Don't just blindly buy into them on the listing day as well, because they were heavily oversubscribed. That is not necessarily the sufficient condition for there to be some more gains. However, let's not paint everything with the same brush. One more question on IPOs, and then we'll move to the other things. In 2023, there are a clutch of sectors which have gotten formed because of newer IPOs coming in. EMS as a bucket saw some terrific number of IPOs, and they've done well, and some of the other pockets too. What has excited you about either newer companies or newer sectors which have gotten formed, or resurgence of some of the sectors, be it PSU banks, be it defense, be it railways, be it some others?
So basically on the EMS side, I think the main story was China Plus One, which was being paid out, and the PLI, which is kicking in a big way for India as such. So I think that to an extent was justified, but as I said, that valuations is one thing that we're very sacrosanct about, and we will not compromise our beliefs in markets. At some point in time giving some sensible valuations. So we'll stay away from those. Having said that, talking about say PSU banks and all that, again, one of our top holdings is a PSU bank, right? But that's mainly because it's one of the best PSU banks that is there there for offer. And frankly, I don't think we'll look beyond that to an extent, because you have to be very careful in terms of PSUs banks per se, because asset quality is always a big question mark. They are mainly into project financing and all, right? They're not a consumer-facing bank. The one which we have is a more of consumer-facing and obviously to an extent project financing, but bulk of it is consumer-facing. That's what we're more keen on, rather consumer-facing banks. Having talking about defense. We have one of the PSUs as one of our top holdings again in defense. But there again, we are very clear that we don't want to get stuck in the cyclical nature of this industry, because there are certain companies which only cater to a specific service, like an army or a navy or an air force, right? We got a PSU which is mainly into all three. He is an electronics manufacturer. There's no problems on the capacity front for him. So these are the kind of names that you look for. Again, the valuations here are fairly reasonable as compared to what the others, the guys are quoting at. So that's what gives us comfort, and that's why I said that we're very selective, though we also very enthused about the way India is going to grow and the way our per capita are going to grow, but we're still not being carried away with those enthusiasms.
Yeah, no, but I'm going to talk about that in detail as well, but after we take a break. But just before the break, Dinshaw, one follow-up question though. On PSU banks, one of the beliefs expressed by some of the people who are constructive beyond the largest bank is that as corporate capex comes back, the PSU banks have raised capital, they have the balance sheet to be able to lend, and the cycle for now hasn't turned back. At some point of time it may, but for now it doesn't look like it'll be a very bad cycle and saddled with NPAs or bad debts. Right. And therefore at 1 times price to adjusted book, they are probably not as bad a bet as they may have traditionally looked. Right. Is that a believable argument? Because you certainly don't seem to be believing that.
No. It's a very good argument. But the fact is that when CapExes come into play, obviously you'll have the private sector also participating. And frankly, I mean, beyond a handful of PSU banks, the others are still dependent on government doles to have their balance sheets expanded, right? So they don't have the propensity to the leverage is already in place there, so they don't have the propensity to grow. For growth, they need government money flowing in. So that's what we're also concerned about, and that's why we're very careful in this particular space.
Okay, and you're careful in defense as well. While you're constructive there, but you're careful there. Now, again, the cross question is that when one looks at any headline that is coming in or emanating from the government side about the kind of monies that they will give into defense business, and the fact that it is not dominated by 1, 2, 3, 4 players, but pretty widespread as well.
Right.
Why is it that there is only one company that catches your fancy?
So our belief is that we have to look at defense beyond the indigenization which the government is talking about.
Okay.
Our belief is that very soon India will be a sourcing base for defense. Look at what the world is going through, right? I mean, there's conflicts all over, right? Geopolitical tensions brewing. So it's obvious that the defense spends of most of the countries are going to go up. And which better place to supply these kind of equipment than India is, right? So that's why we believe that any company which has no capacity constraints, this is what you want to look at in defense, right? So that's why we got certain specific PSU companies. We have certain private sector companies which are mainly into this. So our belief stems from that, rather than purely playing on indigenization of technology in India as such. So that's why we are very selective in our process. And as I said, there's a lot of cyclicality in the industry, in the sense the capacity constraints are there. So even one large order can constrain the capacity for that particular company, which is more of a service-specific company. We buy service-agnostic companies, by the way. So that's why we are very careful here.
Okay, talking about services, talking about orders, we'll talk about information technology on the other side of this break, because I think there too there is a lot of news. Viewers, take a break. Just mark those new listings once before we do that, and come back and talk to Dinshaw Irani about the broader markets and IT services. But just want to mark what Moti Sons, Suraj and Muthoot Microfinance are going through. Well, stable, steady for now, and just in and around the listing prices that they came up with at 10 a.m. Take a break, come back with more. All right, back with Talking Point right here on NDTV Profit in conversation with Dinshaw Irani of Helios Capital. Now, we've spoken about new listings at length. Let's speak about some other stuff. Now, information technology is certainly in focus. Dinshaw, well, Infosys is in news because it lost a large contract again. But, I was just wondering, there's been a very substantial pullback in the IT names in the last 1 month and a half. But until November or November end, or maybe even mid-December, there's nothing that suggested that things will improve. The latest numbers that came in from the global technology companies and the guidance didn't seem too constructive. Very likely that we will not see positive commentary in the month of January. What explains this enthusiasm?
I think it's, there's been false rallies in IT for a while now. I think this is the 5th or 6th one, if I remember right, from 22 as such. And mainly they get fizzled out around the quarterly numbers when they come out. Our belief has been very clear. In fact, we've been sellers in IT from December of 21. Right, we were very clear that when Fed came and said that it's no more transitionary the inflation, it's sticky. We realized that there'll be a lot of constraints on the discretionary spends, and that is what drives margins in IT. It's not the pure bread and butter bodies being thrown at the computers and stuff. That doesn't work for them. It's discretionary work. So that is a call we took, and we were constructively reducing our portfolio. By June, July, I think we were zero in IT, and we remained so for a very long time till we got into one particular IT stock, which is mainly I would say in automation, so I won't take the name, but it's into automation for auto industry.
Oh, okay. So ER&D, if you will.
Yes, ER&D, but mainly focused on automation. So that way, yeah.
Oh,
so
there are two names out there, so it's okay. But yeah,
don't even ask me this.
No, it's just fine. Yeah, don't worry.
And that also was mainly because the way the auto industry was going, and that's why we were very keen on that. Our belief has been very clear that valuations pre-COVID, which were at some 16, 17 times earnings. I'm talking about the grade A IT companies. I would say the mid-cap, small caps are always at a premium, some 30 or 40% premium to those. But the point is that in pre-COVID times, the growth rates were in the late single-digit kind of growth rates, right? Today, if anything, the growth rates are mid-single digits, yeah? Post-COVID, I'm talking about. During COVID, it was a different story altogether because there was a lot of growth expected. There was digitization, cloudification, and blah, 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 right? Which really worked for a while. But beyond that, I think the slowdown started, as I said, that when inflation started moving up, that is what took the back seat as such. So growth rates have fizzled out. Yeah, I think the best case scenario for next year, if you put a gun to my head, I would say that it will be roughly around, again, I think high single digits kind of a growth rate as such, not beyond that, because already the December quarter, nobody's talking about any upsides. Most of the budgets are decided in this particular quarter, right? Or probably going into the next year, probably in Jan or so, and nothing is being decided as such. So it's obvious that they're not keen on spending, right? So that's the best case scenario I'm talking about. Why should I give it a valuation of, say, 40-50% premium to what they were quoting pre-COVID levels, right? So that is what our concern has been, and that's why we said, no, we are away from this sector, and we will not be touching it in a while. We're totally underweight, if anything, even in our mutual fund offering, the flexi cap fund.
Yeah, I saw, if I'm not wrong, just about 4.5% exposure to IT.
Yes.
Yeah, and relative to whatever. Just one quick follow-up there, though, and I don't want to get into names, but I mean, there are only two names. Assuming that you bought into them, whatever, October, November, you didn't buy them when they were very cheap. You bought them when they are either the new IPO or otherwise, they are not inexpensive. So is it growth that will account for the high valuations?
Yeah, so basically, okay, we bought them in October, November for the mutual fund also. So we had it earlier for our PMS and DIF offering.
Yeah.
But the fact was that our belief is that here the growth rates are going to be far more exciting. In fact, only one stock, as I said, is there, and if you check my mutual fund, you know which one I'm talking about. So there's only one particular stock which we are very enthused about. The other one, which is a large cap that we are holding, is mainly because of I believe that's the best in the sector which is there, and that's why I can live with the valuations that are there. But there again, the valuations are not as stretched as in the others, the pre-COVID valuations, I think it's around a 20% premium to the pre-COVID valuations, which is what is giving us the comfort here as such. So.
Got it. The other aspect is consumerism, and I want to love to understand. There are people who make this point about how both ends of the market, one, which is this rising per capita and therefore what it does to premium consumption. We had Indian hotels just before you came in, very constructive. Some of the others, I mean, not just the hotel company, but a car dealer or a watch dealer, etc., etc. People are betting on dealerships from a 5, 7, 8, 10-year perspective. I would love to understand how you think about it.
So I would go with the dealership concept. Yeah, I mean, premium consumption is what will really pick up. I mean, that's what our belief is, and that's why we have certain stocks which are, I would say, aspirational luxury stocks or premium, I would say retailers, but like a car dealership which is into premium cars and stuff like that. Very different from what the rest of the crowd is looking at. So mainly that is the whole way we want to play this. And obviously it's, I mean, we've seen this in the past, right? In fact, our favorite saying is, what we learn from history is we don't learn from history. But we try to, right? And that's why if you go back and see the economies which had this kind of a per capita growth in GDP, it was obvious that affordable luxury or say aspirational consumption was the one which was really picking up and which really drove the economies as such. And that's why we are in the stocks that we are. Having said that, the dealerships are more on a commission basis, right? So we're not too keen on that. And obviously, if you talk about luxury watches, they're hardly available in the market today. I mean, if you go and see, I think Rolex is a waiting list, Patek has a waiting list and stuff like that.
Journalists don't earn the kind of money to buy a Patek
No, I'm just telling you that. So that's where the real commissions are, right? So if you get a run-of-the-mill stock brands, then it's fine, I mean.
Got it. So how are you playing premiumization then? Sorry if I missed it, but how are you playing premium? Let's not get into names, not a problem. Yeah. But what themes?
So apparel companies which are into premium apparels and stuff like that, or say for that matter, hotels and tourism is one big sector that we're playing in premiumization, because we still believe and we continue to believe that the quality hotel rooms are not available.
Got it.
And when you are earning more, you want to stay in quality rooms. You will not be staying in 2-star and 3-star. You want that. And that's where the real, I think, upside for these ARRs come for these guys. And I am sure you must have heard Indian Hotels earlier, as you mentioned. They're also talking about the same. We also thought that it'll be peak this year because of so many events happening, but doesn't look like it. Things are only improving as such, going forward.
He mentioned we are at the start of an upswing which is 3 to 5 years out, and we haven't seen demand like this ever before. It was interesting to hear that.
That's right. So that's why we are so keen on those. We are, as I said, premium auto dealerships and stuff like that. So we are fairly different real estate companies and all that. So that is what we are looking at more for. In fact, today morning, my analyst was telling me that affordable housing is not selling, but the premium housing is what is really picking up. So it's obvious. I mean, in fact, we've seen that earlier also. When these kind of per capitas move up, the concentration of wealth also increases to a great extent. And that's where the real spends come in from.
Got it. Since you spoke real estate, I was looking at a Collier's note wherein they have shown how Q4 of the current calendar has been the best quarter for leasing activity, particularly in the southern countries, but southern cities, but also NCR. Now my question is, while real estate and multiple ways to skin a cat, but is REITs or companies which have a large leasing portfolio a good way to play the real estate theme?
Yeah, so REITs will probably give you it's a standard kind of a yield on the rental that will be given off to you as such. So there's a regular growth. That's a very interesting space, though, which we haven't looked at because we believe that's more of a fixed income kind of space than anything else, though they are on the listed space. But having said that, in the real estate space also, when we look at companies, we look at something which offers you a portfolio of products, not only, say, residential, but it has to be retail, it has to be commercial, and obviously a lot of big leasing portfolio also going ahead as such, so which can be monetized at some stage. So that's why we like probably only one company within, and that's why we are pretty heavy on that company.
South-based?
No. It's a north-based.
North-based one.
NCR-based.
NCR-based. Okay, fine. I mean, there are probably 3 or 4 out there, so can take it.
You can look at my fund portfolio.
Sure. Okay, my final question, Dinshaw, and I know, it could be out there, but just want to understand the conviction. What is your largest overweight? You told me that you're telling people to put in lump sum. You are constructive markets. What is your biggest overweight relative to weightages or otherwise, and why is that the case?
So my largest holding in my mutual fund is HDFC Bank, and that's been our favorite, and not. So at some point in time, it was not the largest holding, not the mutual fund. I'm talking about our earlier avatar where we were PMS and AIF. It had gone down to 4 or 5 as such, and today it's the largest holding, mainly because, as I said, that when these consumption patterns kick in an economy with a growing per capita, you see 2 sectors which do phenomenally well. One which we talked about, which was discretionary consumption or aspirational consumption. The second one is definitely finance. So you'll see my relative overweight in the finance space, which is all BFSI put together, is way higher than what the index is, and that's mainly a consumption facing. Because if you see, as one part we talked about was obviously the capex related part. The financial companies enter that part also. They partake in that growth also, but also in terms of consumption. So it has to be a consumption facing kind of a portfolio, and that's why BFSI is what a massive overweight is.
Hasn't quite performed. You think 2024 will be the year?
Yes, that is what we believe. In fact, if you see till October, I don't think that space did fairly well. Right?
Yeah.
It's only afterwards when the pickup happened, and that's why I believe that even the large cap indices performed well even only after October. Right. So I think that's what is our next rally point, I suppose, in the index.
Well, the big call, 2024 will be a year of large caps from Dinshaw Irani, but more importantly, not afraid to tell investors to put in money to work on a lump sum basis. They're shying away from saying that put it systematically. They're confident on the markets that put it lump sum. Dinshaw, so good talking to you. Thank you for taking the time out and being with us.
Thank you, Niraj. Always a pleasure to be on your show.
It was lovely to have you. Thank you.
Thank you.
And just before we wrap the show, viewers, autos seem to be the order of the day today. Look at all the auto names. They've done really well, from a Maruti to a Hero MotoCorp to others. So autos seem to be doing very well. And media has done very well. If you look at the indices, okay, energy too out there, maybe Reliance is moving, but Nifty Media too, I think, has had a good run today, because I saw the Network 18, TV 18 twins do well, and would be some of the others too, which might have had a good run. So watch out for some of these. But with that, it's a wrap on this leg of Talking Point and India Market Open. Thanks so much for tuning in.
Markets open, the trading week flat. IT stocks drag while autos balance them out in the green. We're tracking 3 new listings today. Motison Jewelers lists at a premium of almost 100%. Suraj Realty and Muthoot Microfinance list discounts. In Nifty IT in the red on the back of Infosys losing out on a $1.5 billion AI contract. From J. Kumar Infra's share rallies, a CLSA hands out a positive report. The stock's target has been raised to 720 rupees from 385. CLSA sees the firm getting large orders in the near future. And shipping stocks, Mazgon Dock and Shipping Corp rally as Red Sea route could reopen soon. Maersk set to resume operations under US protections. Welcome. This is the F&O show. I am Agam Vakil, and in this show we take you through all that is happening in the futures and options space in Indian equities. At the moment, we are seeing some amount of, flashish movement when it comes to the benchmarks. Not too much to speak for when it comes to something like a Nifty or, for that matter, the Sensex. We haven't seen too much, action as far as your underlying is concerned. Sure, we have seen an advance of around a little over 0.25%, but overall, it's been a quiet day of trade. It is something that we were expecting, though the Nifty has now advanced well over the mark of 21,400. The question is that can we expect a little more strength? Do remember that we are not expecting volumes to be substantially higher through the course of the balance 4 trading days of this calendar year. That said, for now, of course, the traction is a little more on the broader market. So let's pull up the broader market indices as well. And let's take a look at where there is in fact a little bit more gains coming. So the mid-cap 100 is up around 0.7 percentage points. And as far as the small cap index is concerned, well, it's a little more mixed. So just higher by around 0.25%. In terms of the constituents too, when it comes to the Nifty, we don't have too much to speak for. Of course, we will have some of your relatively larger weights, like something like Reliance Industries, HDFC Bank, along with L&T, perhaps provide a little bit of support in today's day of trade, but it is in fact Infosys and TCS which weigh down on the indices. Don't forget that as we move into the next few weeks, we will also have something like an Infosys and TCS in focus considering earnings. That's as far as your cash markets are concerned. Coming down to your futures and options space, let's pull up what's happening with the Nifty future. So we do have about a 2.5% increase in OI towards longs potentially, considering we have the Nifty currently trading higher. As far as the Bank Nifty is concerned, once again, we are keeping an eye on your open interest to change. So let's pull up the Bank Nifty as well and take a look at how that one is trading, because up around nearly 7% in open interest increase. But because the Bank Nifty, the Fin Nifty is also going to be in focus, because a lot of constituents of the Bank Nifty are also there in the Fin Nifty. So, and of course, this is the Fin Nifty options expiry. I'm going to talk about that in just a bit, but let's take a look at what the options universe is panning out and how that is in fact coming through. So we are looking at a little more writing around the 21,300, 21,400 puts. And of course, on the higher end, we continue to see a little more traction around 21,800 calls. That's where we are looking at a little more writing. But as far as your range for the week is concerned, 500-point range between 21,000 on the lower end, where the puts have max OI, and of course on the higher end, it is a 21,500 call which has max OI. So that's a rough range we are working with. Of course, a lot could change. But for now, in terms of the numbers, that's something that we're keeping an eye on. If we can, in fact, pull up the open interest distribution for the Fin Nifty as well and take a look at where there is, in fact, a lot more traction. So there you have it. A lot more calls written at the moment, it seems, as compared to puts. And, at the moment, of course, we're looking at 21,200 looking to be defended by when it comes to some of your traders in today's market. So we'll continue to keep an eye on that one. But from there on, we move on to Suraj Estate Developers, which makes its debut today. It's been a quiet one. We are looking at a listing or at a discount. We spoke to Rahul Thomas, the director at Suraj Estates, about the IPO as well as the targets for the company. Listen in.
It's an entirely fresh issuance of shares, so we plan to raise 400 crores, out of which 285 will be for the debt repayment or prepayment. 35 crores is earmarked for acquisition of new land, and the balance would be obviously a GCP portion.
Right. So when you say acquisition of new land, that means that you're obviously planning to launch a few projects, because I assume that you technically take the third party to construct the sites, if I'm not wrong. So when we talk about new launches, do you have any sort of targets in mind, or do you have any sorts of period that you're planning to have these many launches at these many areas, and specifically which geographical area, if you could help us understand that?
We have about three land parcels on Mount Perry. So I think that would be the next market we'll be targeting. So Bandra would be the market we'll be targeting next. And we have a commercial development on Tulsi Pipe Road. So it's about 1 lakh square feet of carpet. Okay. So that would be the launches which we will be targeting. 1 in commercial and of course about 3 in residential.
As far as FY24 is concerned, any sort of guidances or pre-sales or collections that you mostly give out at the start of the year, like other real estate companies, to have an idea as to how the business is performing?
So I can just give you what we did last year. So we did 635 crores of pre-sales last year. I can only say that we are very confident on getting our numbers this year as well. So we are going, of course, we have only 3 months left, and I think we'll be meeting our targets, definitely, what we set up for this year.
Okay, and on that note, let's get in our experts for today. We have Brijesh L. He's of the retail research at IDBI Capital, and we also have Ajit Mishra, who is the Senior Vice President of Research at Religare Broking. Gentlemen, good morning, and thank you so much for joining in. Ajit, I'll start with you. Your view on the benchmarks at the moment. How are you trading them?
Good morning, Agam. So, Agam, the last week was a week of consolidation, but earlier, in the prior instances, we were seeing more of a time-wise consolidation with hardly any major price reaction. But last week was an exception that we saw a sharp decline in the middle, followed by marginal recovery, and today we are seeing the follow-up, the move as well. So the tone looks positive. There is no doubt about that the overall trend is positive. But yes, at the higher level, as you've also shared, that around 21,500, we still have a decent open interest on the call side. Plus, the kind of momentum that we were seeing in the index majors, that has slightly subsided a bit in the recent days. So we feel that closer to around 21,500, 600 zone, will continue to see some buying, profit taking coming in. At the same time, downside, we feel it's capped close to around 21,200, 21,000 zone is the area where one can continue to look for accumulation. So for the index at the current level, it's a no trade zone. One should wait for any dip around 21,200 mark to look for fresh longs. And on the higher side, around 21,500 plus zone, one should look for booking profits. Banking, it was showing sign of resilience till Thursday, but on Friday, the close were not very decisive. So I feel for the banking also that this range will continue, 47,500 on the downside and 48,000, 48,200 on the higher side.
Okay, that's your view coming in as far as the benchmarks are concerned. Let's get in Brijesh into the conversation. Brijesh, good morning. How are you trading these indices?
Yeah, good morning. So, as you said earlier, the range for the Nifty would be somewhere 21,000 and 21,500, because these are the both ends where we can see the call and put writing. So definitely 21,500 is the immediate resistance. There is a lot of call writing, but what we can see during the first 1 hour of the trade, that slowly these call writings are getting unwinded and these levels are slowly getting shifted to the 21,800. So maybe there is a chance if we see a close about 21,500, I think that another 200 odd points move can be there on the higher side. I believe this all-time high level which we saw the last week, close to 21,593, maybe retested, or maybe those levels, somewhere close to those levels, I think index can approach. Even though on this is a truncated week and we have expiry on Thursday, buyers would be a range bound, but definitely buy on decline would be the strategy for the Nifty. The same way, if you look at the Bank Nifty, definitely 48,000 is a level where a lot of call writers are there. Right now, even in today at 47,800, there is some amount of pressure is there. I have a sense that if you look at the stock specifically in the banking space, Axis Bank, Kotak Bank is showing some amount of strength. So by any chance 47,800 is taken out, then I think there's a probability we'll go back to 48,000. And maybe in the next 1 or 2 days, if 48 is taken out, then definitely we'll be seeing a good short covering in the Bank Nifty.
Okay, so keeping an eye on positive cues, that's as Brajesh's view as far as your broader markets go, of course, at least as far as the benchmarks are concerned. And at the moment, we are looking at those kind of gains. Of course, for the Nifty, we are now clearly above the mark of 21,400 odd levels. And for all you know, we could potentially be making a beeline for 21,500 in today's day of trade itself, considering the Nifty is trading at life highs. But on that note, we slip into a short break, but don't go anywhere. On the other side, we talk about stocks and a lot more. Stay tuned in. Welcome back. Motison Jewelers listed today at a 98% premium. My colleague Sajith Mangat spoke to Laksh Chhabra. He's a joint managing director at Motison Jewelers about the company's overall outlook as well as the growth outlook. Before we go across to that conversation, so I want to quickly point out as to where it is currently trading at. It is trading exactly around the levels at which it opened at. Currently at about 103 rupees per share and currently at 88% premium to its issue price. So a substantial up move out there as far as Motison Jewelers is concerned. We continue to keep an eye on that one. I reckon that considering the kind of volumes that we are seeing, there's no letting up, at least at the moment. But let's go across to that conversation my colleague has had with the joint MG. Listen in.
our quarterly first result was very good, like compared to last year, as you can see. And as seeing the growth trend change in the market, like demand is also changing, more festivals also coming. So we can see a demand change, and we think that we can have a good growth in that.
How was the first half of the year, September quarter?